This panel will be moderated by Frank Edwards, and the panel is about financial inclusion. Please give them a warm applause.
Hello. Right, good morning, everybody. My name's Frank Edwards from Pearson, and Pearson is delighted to be sponsoring this Fintech week here in Turkey, and I'm also delighted and privileged to be moderating this important panel. Just a few words. I have been involved in looking at educational ecosystems for several years now, working with governments, and we know that there is somewhere in the region of 172 million people unemployed. We know that there are some 71 million young people unemployed. And one of the issues around that is that some of those people have the skills and the ability to be able to work, but one of the problems is a lack of access to finance and an access to capital. And we know that without that being within an ecosystem, then that ecosystem is not working properly. So when I talk about educational ecosystems, it's not just about the education, it's not just about training, it's also about the linkage between the economy, the skills, what the economy is doing, the technology that is driving that economy forward. And so when we come to financial inclusion, the aspect of the financial inclusion ecosystem is just as important. And what is important is the linkages between those ecosystems. Now, this morning, if I can introduce the panel, we've got Aksinya Sorakina, Global SME Banking Specialist from the IFC and the World Bank Group, and I'm sure she'll bring some fascinating insights to our discussion. We've got Konstantinos Papakonstantinou, Chief Data Officer at Creditech, and again, I think some important insights to the whole issue of financial inclusion. We've got Eric Rood, who is partner at KPMG and specializing in financial risk management. And we also have Berku Karpuz, Regional Director. I think it's Finance in Motion, but you're also responsible for the European Fund for Southeast Europe.
Yes, we are advising.
So I think, as you can see, we have a very talented and a very experienced panel to be able to give their insights onto financial inclusion. Now, what I'm going to do is I'm going to ask each of the panel members just to give an overview of financial inclusion from their perspective and also from the perspective of the organizations that they work for. But before I do that, let me just give you a couple of comments. If we look at the disruption through the fourth industrial revolution, there are many industry sectors that are still waiting for this to happen. In the financial services sector, we're in the heat of it, we're in the heart of it, and these people are not just involved with it happening, they're a part of what has actually happened. If we think about the impact of technology, a third of the world's population have access to mobile phones, smartphones. So we have China, India now overtaken the US, and then obviously the US in third place and others. Now with that widespread penetration, we're not looking at the fourth industrial revolution, we're actually living within it, and the pace of change is what's so critical in terms of what is happening. So if I can ask our panel members, and from here to the end, if I can then ask them to just give us their perspective.
Okay, I'll go first. Thank you, Frank. So financial inclusion, I'll try to touch upon just a small part of it, given that I'm the expert of the data area as opposed to everybody else that will have a different approach and look at the big picture. So it's technology, of course, like you mentioned, that could enable financial inclusion both in emerging markets where people are underbanked, and this is something that has been discussed extensively. However, I would like to focus on where do we go beyond that? Where do we go beyond just having a digital bank where people can access through their mobiles or through their laptops? And for me, it's important to point out that due to the excess of data that are available and due to technologies like machine learning, artificial intelligence that we will be discussing extensively during this week, it becomes feasible to offer all different kind of financial products to all different kind of customers. So I have personal experience, for example, as a customer before going to what we do in our organization to help our customers of getting access through my mobile bank to financial products and investments, to be able to do investments with just a few simple clicks and selecting the right products, and that would have not been possible before if the right technology was not in place and the right data was not in place to be able to assess all these different kind of investments that there are out there. Beyond that, what this kind of technologies enable us is to reach out to customers that have been traditionally ignored by financial institutions and banks, and be able to offer them products like, of course, banking, the very basic banking products, but also access to credit, where every other institution has failed them, because we have access to the information needed to be, for example, able to underwrite those customers and enlarge the customer base and reach out to the biggest part of the population. And we're talking the vast majority of the population do not have access to credit, both in emerging and in developed markets. So these are a few things that I will be touching upon. I'll pass it on to the other speakers now.
So, Aksinya, from your perspective.
Thank you, Frank. So I'd like to bring a light a little bit on the financial inclusion topic from the IFC World Bank perspective. It's a very broad topic, but I'd like to focus today on the financial inclusion from the perspective of the small and medium enterprises. SMEs contribute tremendously to economic development. They are one of the drivers of the job creation. They contribute between 70 and 90% of the new job creation around the world. They contribute more than 50% to the GDP in both emerging and developed world, emerging countries and already established countries. However, as per the IFC research, there is a 5.2 trillion finance gap for micro, small, and medium enterprises in emerging countries. It's huge untapped opportunity for financial institutions. In addition to this, there is around $2.9 trillion in the potential demand for financing in informal economy. So we talk about the formal economy with a 5.2 trillion finance gap. We talk about additional 3 trillion financing needs in the informal economy. The market opportunity is in there. However, what we observe at IFC in the World Bank, that the financial institutions currently are not tapping enough into this market. The loan portfolio of financial institutions are only about 20% allocated to micro, small, and medium enterprises. There are certainly different ways how you can improve the situation. Banks, due to their legacy operational systems, inability to understand the customer, disconnect with the market, they still struggle tapping into this market. But with the new technologies Frank mentioned earlier, the fourth industrial technology revolution, as I call it, really drives the progress. First of all, of course, collaboration with the fintechs. And we see great examples of the fintechs in exhibition here today and tomorrow. These fintechs provide a tremendous support to banks in terms of the automating the internal back office operations and also the front office functions such as payments, underwriting, KYC, and others. platform economy, platform revolution, that's another big topic that we are exploring, and we are working around the world on helping SMEs access financial services through the platforms that are leveling the playing field for many SMEs. And of course, the digitization of the financial institutions themselves, which is probably the most difficult part of the work, because those financial institutions have huge operations, not really flexible, but still have to transform and digitize in order to serve small and medium enterprises in an efficient manner. Thank you so much. So I'll pass it on to the next speaker.
Thank you. And if we can ask Berku, please.
Yes, I mean, from a very basic definition, we all know that financial inclusion means for an individual or for a company to have an account with a bank or a payment service provider. So when we start from that point, as F said, what we are doing is, apart from having this account opening, what we understand from financial inclusion is for these individuals and for these SMEs also to have access to finance, access to loans, but also have the capacity and the services for their risk management, for their cash flow management, and also the others. EFSA is the largest micro and small company finance fund globally as of today. And we have three main pillars for our support in terms of financial inclusion of mainly the micro and small companies in the region, in the developing economies. So what we focus first and what we try to do first is to bring together the investors all around the world who are interested in supporting financial inclusion in developing countries through a fund mechanism where they can invest, and so that we can all lend this money to the financial institutions and other service providers in the countries of operation, so that this money could be all lent to the entrepreneurs, startups, micro and the very small companies in the regions who have very limited or no access to financial services. So we see that this is the requirement, and I mean this is a necessity for the financial inclusion. Without having the finance or without providing the finance to these institutions in these emerging or developing economies, there is no way to increase the financial inclusion in a realistic and in a sustainable way. The second pillar is, of course, we try to provide that funding in a local currency, because we never want the borrowers to face any foreign currency risk or devaluation risk. So what we are trying to do is to find the ways and the tools to provide the local currency lending for these small companies, micro companies, entrepreneurs, so that they can grow their business, and we can have the support for the youth unemployment especially. And then, of course, as a third pillar, what we are regularly providing is the technical assistance to the financial institutions, because without capacity building for these institutions, without them understanding the financial inclusion, without these institutions developing their own lending capacities, risk management capacities, product base, we believe that further financial inclusion of especially the underdeveloped groups or the disadvantaged groups is kind of not possible. So as F said, the first step that we take is to support the financial institutions, to support microfinance institutions, banks, and other lenders and service providers in these markets, to make sure that they have better access to the disadvantaged groups and the people, the companies who currently have no access to funding.
Thank you, Berku. And if we can ask Eric, please.
Thank you. Yeah, from a KPMG perspective, we have developed a new proposition which we called optimization of the lending cycle, which is exactly tapping into the huge opportunity of financial inclusion. As already said, there's a huge untapped value which is not being monetized yet by banks. And we advise clients to become aware of that gap. And the gap is not only in the developing world. Obviously, there's a very large population of underbanked people, about nearly 2 billion still. But it's also about what we call the underserved. Because even if you have an account, then the next step is, okay, can we offer that person a loan? Is that micro SME eligible for a loan? And that's the tricky one, because the traditional banks are typically hesitant to go to those people because they are perceived to be very risky. So what we do and what we have recently done is we have taken a stake also in a Fintech company called AdviceRobo, which is exploring and have evidence in looking for different ways of credit scoring, also making use of psychometric credit scoring, so looking at the behavioral of clients, of micro SMEs. And the trick is in to gather as much data as possible from these new entrants in the financial system, use that data, add new data, for instance, via using psychometric credit scoring, and then being able to start providing loans to these customer groups. That goes hand in hand with the digital transformation. That's obviously also in a territory where we as KPMG can advise banks. So it's typically a broader question, but it starts with the awareness that there is a huge potential in the market. As said, not only in the developing world, also in the developed countries. Even in the Netherlands, where I'm from, you have groups, migrants, self-employed, startup companies who have difficulty to access credit. And also for those groups, alternative credit scoring techniques could be a very good solution to include those people. Because as said, there's clear evidence that if we, the financial system, start to include these groups, then there's a big uplift in GDP to be expected. And that's not just a few percent, that can be 10, 20, 30% GDP increase in many countries.
Thank you, Eric. I think one of the important points that emerges from this discussion is how broad financial inclusion really is. Eric has touched on the fact that 2 billion people are still marginalized and excluded. We've heard how important it is for micro and medium enterprises to have access to finance in order to grow. Now, you can see that financial inclusion is necessary for inclusive growth and the reduction of poverty and inequality. Now, in order to focus our discussion this morning, I'd like to read the text that we're going to keep the discussion focused into, because all of our panelists have referenced these points as we've been discussing. So, emergence of smart technologies has ushered users to a better access to financial services. That is financial inclusion. Financial inclusion means that individuals and businesses have access to useful and affordable financial products and services that meet their needs. Transactions, payments, savings, credit and insurance, delivered in a responsible and sustainable way. So the panelists will be focusing on that as they give responses to some questions, and I will make some time at the end to take questions from our audience. But the panelists will be discussing how Fintech and user-orientated digital services help improving the lives of millions. And this is the important point, isn't it? It's about improving the lives of millions, sustainable development. Now, from our panelists, you have a captive audience here who are all interested in Fintech, how these technologies are impacting, as we've heard, credit ratings from people which a normal bank wouldn't be able to process, but there are organizations in the market that are able to give that kind of credit rating. But if I was to say to our panelists now, there's two things you want the audience to be able to take away from what you're going to input this morning. what would those two things be? What would the two main points be that you would say, if they really took that away, I think I would be imparting something of value? So, Eric?
Well, keep it simple. Start with all the data that you already have from your customers and start to analyze what does it learn to you? How can you use that data to better predict whether you could accept this customer or not? Because that's a very easy first step. And from those learnings, you can say, okay, how can we adapt that and how can we use that to target new customer groups? And what kind of techniques, what kind of fintech algorithms, new credit scoring techniques can help us to also accept the underserved. So it's really going to the basics. What is my data today? How can I use my data? Which kind of techniques? AI, machine learning is a bit of a buzzword, but it's just a means to achieve a goal. The goal is to better predict risk, not just for your new customers, but also for your existing customers. And then if you reach that goal at a certain threshold, then at the same time you look at other techniques, other ways to attract more data. So the value is really to be very mindful and very serious about how to treat your data and start analyzing that.
Thank you, Eric. So the importance of data, not just data for data's sake, but as Eric is saying, how do you take that data, how do you apply it, and how does that data increase access? Aksinya, 2 points from yourself?
I think the largest mistake that I'm seeing the banks are doing at this point, seeing fintechs as their potential competitors. These days, fintechs can do almost all functions that the traditional banks do. It might be the lending, payments, transactions. Some fintechs offer saving programs as well. But fintechs, although yes, fintech industry is growing rapidly and the investment in fintech has been, in 2018, $60 billion has been invested globally in the fintech industry. It's a huge number and it's been growing rapidly at the rate of more than 50% over the past 5 years. However, they do not have capabilities to reach to those underserved segments, youth and millennials, women-owned businesses, small and medium businesses in the rural areas. They do not have means and capacity to reach deeper into the markets. So the partnerships between the traditional financial institutions and the fintechs is crucial. And a lot of banks are currently doing this, both in emerging markets and developed world as well. Citibank invested in over 20 fintechs at this point. Santander BBVA created their own APIs to attract fintechs and to give an access to fintechs to utilize their own platforms and their own services. Banks can partner with fintechs in specific areas where the banks are not very good. For example, eKYC, use of data analytics for underwriting purposes, back office engine calculations on the back office. They can invest in fintechs. They can create their own programs where they or venture capital funds were investing in fintechs. So there are various ways of working together fintechs. But the success in financial inclusion will be reached only through the collaboration. So this collaboration between the traditional financial institutions and newly emerging fintechs is crucial for financial inclusion.
So if I'm reading you right, it's not just about the technology. It's about the partnerships that enable ecosystems to evolve, and in partnership we're able to reach those people that ordinarily wouldn't be reached.
Absolutely. Just take an example of M-Pesa in Kenya. The market has been largely underserved. The access to financial services was close to to non-existence before mobile money appeared in the country. And right now, close to 80% of the population of Kenya has an access to financial services because they were able to use their mobile phones to transact at first place. And now they're already moving to the lending. And the success of M-Pesa was not because M-Pesa had a great idea. This idea has been around for a long time, but because M-Pesa partnered with Vodafone to create a partnership and give an access to the wider audience, to the wider market. So in the same way, banks are partnering with large banks are partnering with the smaller fintechs to increase reach and deepen the relationship with the customers.
Thank you for that. And I think what we're seeing is that partnering is able to add value, and that added value is able to extend reach and enable access. Berku, from your perspective, 2 main points.
Yeah, I mean, what I would say initially is there are lots of fintechs out there in the market. So you see that there are new names, new companies, new technologies, new ideas going out to the market every day. But we see that some of them are not really feasible, or they don't really understand the needs. So I think these institutions, these fintechs who really want to increase the access to finance, or if they really want to support the financial inclusion, first they need to understand the needs in the markets that they are operating. They need to see what the banks are offering and what the people really need to be a part of that financial system and what is really missing. So if they can make a proper analysis of these gaps, I think this is the first step. So that is at least the first step for the success. And then what needs to follow after a proper gap analysis and understanding the needs of the market and what kind of products should be offered, then of course they should come up with a proper business planning, proper structuring, and then all the other things that a proper company would need, maybe not at a large scale, but at least in a small scale, in order to be sustainable and in order to continue delivering that service in a longer term with a reliable, growth. Otherwise, we see that these, ideas are just going out and they are doing certain things, but they are basically relying on certain grants, and it's not becoming sustainable. From that perspective, I think there are a lot of institutions out there in the market, a lot of companies like IFC and FSA and others, to support the fintechs, not only from a financial perspective, but also from non-financial perspective, because they need a lot of assistance, they need a lot of support. So these companies should be benefiting from these services, non-financial services as well, provided by these large institutions to develop their capacities internally. That basically would be my first point. The second point I would say is it's also important for these fintechs to gain trust of the people locally in these countries as well, because in order to get a service, in order to use a product, you also need to support that fintech, or you need to support what they are offering to you. So I think that link between the service provider and the people who get the services is also very important, building this trust relationship, understanding what service is provided. So that should also be a simple and understandable service so that people can also use it easily, because we're talking about mainly uneducated people. So I think providing the services and that could be understood by those people, and gaining the trust of those people is also very important for the further development of fintechs. And I definitely would repeat what my colleague is saying, that this cooperation with financial institutions is very crucial. I think at one point fintechs should be supporting the banks or other financial institutions in the market to increase financial inclusion and to increase outreach for these larger institutions to provide their services to the disadvantaged groups as well, or the groups who have no access to finance.
Thank you very much for that. And again, 2 extremely important points. It's not just about fintech seeing opportunities in the market to come in without understanding the market and understanding what's actually happening. And it goes back to the statement in the beginning. This is about responsible and sustainable development. So what we're looking at is partnering, learning from each other, enables fintechs to come in and to make the impact that we're actually wanting them to make. That second point, again, is so crucial about trust. about products and services being easily understood. And my point in the beginning about ecosystems, if you have a financial inclusive ecosystem that doesn't have the education and the awareness raising built within it, and that becomes a flawed ecosystem within itself. So it's not just about how do you get people in, it's actually how do you get people in and then further development from that, which I think we will touch on a little bit later. Now, if we come to Konstantinos, 2 points from yourself that you would really like to get over to our audience today.
Right. I think there were many interesting points raised, starting from data. Of course, you need to leverage data as much as possible. And then we discussed about partnerships between traditional institutions and fintech, and this is very, very important. I'd like to augment that and point out that also, like you mentioned, creating an ecosystem where also fintechs partner with each other, that's very, very important. That's something that CredTech has done successfully by partnering with online payment providers, and thus we're able to offer consumer lending products to the customers of online payment providers. That has been very, very important. And then last but not least, you mentioned, and then we discussed about responsible and sustainable development. What I would like to add to that is scalable development, because we did mention about the big size of underbanked or underserved customers. So how do you scale? How do you reach all of these customers, and how do you serve all of these customers without having your costs exploding? There's a simple solution to that, and the solution is just try to apply leverage technology, leverage existing solutions as much as possible that can come through partnerships, and try to apply technology in every step of the process. When you're serving the customer, from acquisition to, for example, when you do consumer lending, to the underwriting, to the loan servicing, to the CRM and collection efforts, you should seek automation in every step of the process by using technology, either solutions that already exist or built in-house when they do not exist, and leveraging data and the technology that we already mentioned, like machine learning can help a lot in that direction. That's the only way that you can scale up and actually reach millions of customers.
Thank you for that. And again, you can see this aspect of scale. Scale is important, and I think that's the reason why, Konstantinos, you're saying that there has to be technology, because it's the technology that gives you the scale. I think the other point, and it goes to what Berku was saying, is that, look, you have to pilot. You have to make sure it works. You have to really understand the client group that you're trying to reach. And it's in that process of piloting that you really understand what you're doing, and the inclusion of technology is where you're able to scale. And I think we're going to touch on all of those points as we go through. So I hope with the 8 points that have been conveyed to you today, that's an important takeaway that you can build upon yourselves. If I was to now bring another question in terms of, given the widespread digitalization in financial services, why is it still a challenge for billions to access basic financial services? And it was mentioned by Eric, 2 billion people still unable to access. So in terms of why is this still a challenge, and why is it that more than half the adult population are without access to financial services? And maybe, Berku, if I could pose that question to you first.
Yes, of course. I mean, what I see from the markets that we are operating is, yes, we are talking about fintechs, we are talking about increasing number, the growing technologies, but I think there is still a lot to be done. We are still talking about many markets who are dominated by the financial institutions, large financial institutions like banks and others, and sometimes the MFIs. But still, the fintechs operating in these markets are not, I believe, is as much as it should be. So that's kind of limiting the financial inclusion. I mean, still you are trying to push these smaller companies or these individuals to have access through these financial institutions, which basically doesn't have any appetite because they see them as very risky. But I also would like to now switch to the other side of the coin, because while we are saying these institutions do not have any appetite, so fintechs is great to have, they are just going into these markets, they are providing all these services and increasing the access to finance, which is happening and which is very positive. But we also have to focus on the startups, the SMEs, the very small companies. We also have to make sure that they understand what it requires to have access to finance, or for the individuals, what it means to have a saving, to open an account. So we need to work from both perspectives. So from an EFSA side, I can say that we are doing both at the same time. For example, we have EFSA Entrepreneurship Academy, which was established a little bit longer than a year ago. So while we are supporting all these fintechs through some events and technical assistance facilities, and then all the support provided to the financial institutions, we are also working directly with many startups or the incubators to teach those companies, the very small companies, how to have a proper business planning, what kind of documentation they would need, how they should approach a financial institution, whether it's a bank or a fintech, to ask for a loan or to open an account or to do some kind of risk management or cash flow management. Because this is also very crucial. Whatever you provide as a service in the market, as long as the people who are supposed to receive it do not know how to access that or do not keep proper track of their records, this will still be limited. I mean, you still will not be able to outreach to as many people as you wish to. So I think this is also kind of a challenge in these markets, and this is also kind of limiting the access. And then we need to work from the other side to push those individuals and the very small companies, SMEs and startups, to understand what it requires to become a part of that financial system. I think this is developing now gradually in these markets as well, with the support of the central banks, with the regulators and other stakeholders as well. So I think this is very important.
So again, two important points there. The appetite sometimes isn't there, and maybe the benefits are not clearly understood by those micro enterprises or SMEs, that what access to financial services can really do to help them not just grow their business, but to be able to sustain that business. Aksenya, from your perspective.
Yeah, I think the question of why we are seeing the financial exclusion or lack of financial inclusion is a really, really serious and big topic, and I think all of us can talk hours about this and about the reasons for this. But I will approach this from three angles. First of all, these are the service providers. These are the banks, fintechs, non-bank financial institutions, microfinance institutions, angel investors, and so on. They have certainly a lot of issues, a lot of problems, why they are not capable or not willing in providing access to finance. It's appetite to risk, it's funding issues, it's technology, which is in many cases it's in a quite poor condition. Second big point is the users, those for who need to access finance, and that's where Burcu was mentioning the financial knowledge or financial education, financial literacy. A lot of the people who are lacking access to finance, we know that they lack finance, but they themselves might not even know that they need finance to develop their businesses. They need working capital finance to drive their business and scale up their development. People who still transact in cash, they don't know that they might be better off transacting through the digital channels. So the financial literacy is a big topic, and we at IFC, we work with the financial institutions, through the financial institutions, to educate the final customers. We call this non-financial services. It's probably you also have the same terminology when we create the educational programs for small and medium enterprises and for the individuals on how to access financial services, how to apply for loans, how to develop the business plan to present to investors. This goes way beyond the funding needs. So financial service providers, consumers, and the third, which is the biggest one and the most challenging one, is the enabling environment. And ISC is a part of the World Bank Group. We very actively work with regulators around the world on creating enabling environment for financial inclusion. In Europe, more than 60% of the EU member countries already developed the digital transformation plans on a country level. Most of the countries in the developed world and about 40% of the countries in the developing world already developed the financial inclusion strategies on a country level. When you have understanding from the top, from the country level, from the central bank, from the Ministry of the Development or Economy, when you have this guidance on what it means, what financial inclusion means and why it is important, how this will be reached, what kind of support the government will provide. Just take the Singapore as an example. Singapore Monetary Authority created was one of the first countries, maybe after the United Kingdom, who developed the very comprehensive governmental support for financial inclusion, which was based on the multiple Fintech incubators, supporting EPI platforms, open banking, use of data, providing not only funding, which funding was also there from the government side, but more environment where the companies can operate, financial institutions can test the new solutions. Of course, the sandboxes for testing different new models and new products. So that's something. Enabling environment is the third important pillar, which I think needs to be taken into account.
And I think again there from, Aksenia's response, what we can begin to see is the complexities around financial inclusion. If there's no national plan, if there's no support, if there's no awareness, if there's no coming down to be able to pull the different strands together, whether that be funding, the technology, the providers, then that's a weakness that works against financial inclusion. Eric, from your perspective.
Yeah, I think lots have been said already, so I have my experts on financial inclusion on that part here at the right of me. I think to touch on financial literacy, that's an important one. And one of the points that I was thinking of is, okay, we have to educate the people, but how do we do that? I mean, those people just don't go to a bank. They just don't do that. It's too far away. Maybe they trust it, don't trust it. They don't think they need it. So the way is probably also to look at what are the access points, what are the communities, maybe what are where do they do investments. If they buy something, if a small medium enterprise buys something, then at that access point, there should be a way to help these people if they are not financially educated. So it's really looking into how does this person doing business and what are the sort of stakeholders, parties around him or her that you can influence or where you can tap into to make available this financial education. So that's one point. And the other point is probably on the product side and the experimentation side, where I really believe in just try and learn and adapt, etc. So if you see, okay, there's a large group of people who don't have access to finance, and we think there are 3 or 4 reasons, just try to start pilots with different products, simple products specifically designed maybe for women, or which may have different needs than men in terms of financial access. So really don't think you can sort of write it all down from the top. You just really have to test it out and see what works and what doesn't work.
I think again, a really important point. If we're going to wait for ecosystems to percolate down, the market has moved on and the opportunities are not there, Financial literacy, I hope my colleagues from Pearson are listening, because this is an area that we should be working in partnership with organizations to make these things happen. So ecosystem's important, but we have to have a two-pronged approach. Things that are happening, piloting, sustainable, being able to get that scalability brought in. Consentinus?
Well, what I would like to add is we need to step back and think how the fintech space was created in the first place. I think the term must not be older than 10 years. And fintech companies all started as disruptors, right? I think we need to replace that. We shouldn't be focusing on disrupting, we should be focusing on enabling. That's the key thing there. So we wanted to disrupt the financial services because customers were dissatisfied, because customers were excluded. And this is what we're discussing here today. But even at this point, this paradigm has not shifted completely. So there's just a handful of partnerships between traditional banks and fintechs as we speak globally. I'm not aware of more than 5 or 10, to be honest. So instead of saying this is what we're going to disrupt, fintech players should say, yeah, this is how we can, you can offer more services to your existing customers, or here how you can reach more customers. This is exactly what we should do. At the same time, it was a space that was largely unregulated. And we would be lying if we would say that fintech organizations did not take advantage of that and used irresponsible techniques and irresponsible development, both in terms of use of data and use of technology. This is changing day by day, but even if it's not there, regulations are not there, I think it's to everyone's benefit, including the fintech organizations. If they reach out to the regulators, to the DPAs, the data protection authorities, etc., and they work with them into sustainable solutions. So I think those are the things that are missing. And day by day, the situation is improving. We'll see more customers being included exactly because of that.
I think, again, important contributions there, working on enabling, because enabling is actually making things happen and having an impact. And I know that impact is something, Berku, that you're very much interested in within your organization. But in terms of the other points, I mean, it was mentioned, you know, the idea of physical location, the bank being too far away, the availability of technology, also regulation playing a role whereby people then have more confidence and more trust. And all of that, again, is ensuring that ecosystems are driven from national plans, but you're not waiting for ecosystems to come about. You're actually working with what you've got, but keeping those key points in mind all of the time, and that is to do with responsible and sustainable financial inclusion. Touching on a similar point now, why is it then that so many women are absent from financial inclusion? And the research clearly shows that they are the largest group. Berku?
Yes, I mean, as a woman, I think it's a shame that we are basically excluded.
We all agree with that.
Yeah, that we are excluded from the financial system more than the men. But I mean, there are different reasons for that. I think the main reason is because of the fact that the participation of women in the workforce is much less than the men globally all around the world. So if you are part of the workforce, then it's easier for you to be a part of the financial system, to have an account and, you know, to have an income, and then to be a part and to be financially included. But for different reasons, and mainly for cultural reasons, if you are excluded from the workforce, you are already starting everything from a step behind. that it takes you a little bit more efforts to be financially included. So from my perspective, this is one of the reasons. The second reason, I mean, if you look at our region and some close by countries, you'll easily see that also culturally women are not so much welcome to be a part of the financial system as well. So it's more like a man's role to be active in the financing of the family or in the savings for the family rather than a man. But having said that, I think all are also aware of the fact that if women are included in the financial inclusion and if they are part of the income and a part of the savings, then the family savings are basically increasing at least like 1/5 or a quarter of the total savings that a family can make. So the women are definitely better savers than men from that perspective. So we need to include women in the financial system. We need to make sure that they have a saying in the family from that perspective, that they have an account and they actively contribute, especially in terms of savings for the family. I know that everybody is running special programs. IFC has a program for financial inclusion of women. I mean, EFSA has, and so many other stakeholders do that as well. I mean, there is a progress. We can see that. We can see that in the figures as well. But I think there is a lot more to be done.
So I'm not going to extend that question to the rest of the panel because I think Berku has articulated that. I think what we begin to realize, there are cultural issues in different countries, but it's unacceptable, and it's something where, you know, governments, organizations, NGOs, other entities need to be doing more to be able to explain the benefits of financial inclusion for women. Now, in terms of another question.
Frank, do you mind if I add just one?
Yes, of course.
Because this topic is really important for IFC and the World Bank, and thank you so much for bringing this up, Burcu. I mentioned a couple of numbers early on the overall market, but there is a 1.7 trillion finance gap for women-owned enterprises only. There is certainly disparity between financing needs and current finance offered to women-owned businesses or to females. There was a study done, and there was estimated that if women participated in the economy in the same manner as men, then the global GDP would increase by $28 trillion. Just think about this number. It's a significant gap, and the gap is everywhere. Why that is happening? That's another topic for discussion. Women use mobile internet at least 25% less than men. Why that is happening? Financial literacy, as you explained earlier, cultural differences. IC has several programs, and 2 years ago we launched a program in partnership with the Goldman Sachs Foundation called Banking of Women Entrepreneurship Facility with a total funding about $1.5 million specifically to own land to women-owned enterprises in emerging markets. So far, about 1 million has been already disbursed to different financial institutions for them to own land to women-owned businesses. There are of course success stories. We work in some of the most difficult countries in the world. In a great case in Palestine, where we created the mini MBA program for the women-owned businesses, and those women who went through this MBA program. Now they are successful entrepreneurs running their own businesses in the country that you would expect being very, very much conservative and male-dominated. But this was a great example of how this can work, this kind of program and this kind of support can work, and lead other countries or other institutions by example.
Thank you very much for that important point that's made. And I think again, you know, this is a challenge, and to go back to Berku's point, it's a shame that this situation exists and more needs to be done, but there are great examples already out there. In terms of the way that financial technology and innovation has impacted the financial inclusion scene, I noticed that the G20 had produced an 8-point plan, and that 8-point plan really highlights all of the points that countries need to take into consideration, because we've had great success, 1.2 billion people accessing financial services since 2011. But with that success becomes many of the challenges that the panel have articulated here today. In terms of what is the role of online payment and remittance services in addressing or fixing the challenges of inclusion, I think it's not a simple question to ask, but if I could just very quickly ask each of our panelists to give a comment on that before we conclude our session. Eric?
Yeah, well, I think one of the big drivers of this tremendous success, of this 1.2 billion people who got access to the financial system, I think certainly a large driver is eKYC, so a simple digital authentication algorithms, methods, which allow people to easily identify themselves and to be able to create an account. Also, good examples of mobile wallets offered also by telcos, which allow people to open a mobile account and transfer money easily to other people. Also, what you have seen in this, well, I would say opportunity for lenders, especially for peer-to-peer platforms, is that as soon as these people have access to an account, they would probably also maybe are looking for a loan if they want to build up their lives, want to invest, etc. So you see that many peer-to-peer platforms have jumped into that opportunity, and that has mixed results so far. You might have seen that in China last year there was, I think, 250 peer-to-peer platforms went bust in 1 month, which was not very promising for the trust and also for investors to keep on providing funding to these platforms. So what we have done from a KPMG perspective is also to look into, okay, but what is it that it takes to run a good peer-to-peer platform? Because on the one hand, it's good that these peer-to-peer platforms come into place, and to step into a market where traditional banks are not yet tapping into, or not yet enough. But it requires all kind of stuff to really run the business in a good manner. It requires transparency about interest rates, about the product, about the number of defaults, for instance. It requires sound risk management, and how do you track and monitor performance of your customers, and how do you report that back to your investors. And it requires service, and how do you cope with complaints, how do you cope with fraudulent behavior. And if you don't have that in place in a good manner, then some way or another you will have a difficult time, and as you can see from the statistics, lots of peer-to-peer platforms do not survive. So, and the reaction from the regulator is obviously to impose very strict guidelines and to make it much more complex to apply for a license, which is going maybe too much in the wrong direction. So that's why we, from a KPMG perspective, really advocate to have a very serious understanding, and also what requires it to be a good lender, and what you need to do for that, and also to demonstrate that to your stakeholders.
So Eric, that structure is important, and I think the point you're making about regulation is important, but you don't want over-regulation that is going to stifle innovation. But also that same point that Berko made earlier on is that if we do have that regulation in place, then it will prevent some of those people who are just coming into the market, who are opportunistic. Any other comments from the panel? Because I did say to the audience I will give them an opportunity to ask questions, and I think I need to do that, but we're running out of time. Are there any burning questions from folk in the audience, or can I be able to pull this together and conclude?
Not yet.
Thank you very much for giving opportunity to ask questions. I was listening very carefully and understand that all what you were talking about somehow connected with the customer experience delivery to the customers in the finance sector.
Speak a little bit closer.
And you were mostly talking about the data and data analytics. My question is, what kind of data are you talking about, and what kind of measurement points are the finance sectors must pay attention to improve the situation in the market and stakeholder?
I can address
Who would like to address that?
I can start with that. Thanks for your question. So the good thing about the use of technology and data is that you don't have to cherry pick in advance the kind of data that you would like to use for your product. You could have an idea based on some domain expertise, but I think we're again moving beyond that paradigm. There are so many rich data sources out there, and what you need to do is run experiments and create proof of concepts to see how this data can help with your product. So at CreditTech we do consumer lending, so of course the main reason we use data is to underwrite, and we have experimented with different data sources, including in the past, for example, social media, which is something that we don't do today. What we have seen is that the more data that you can leverage from alternative data sources as opposed to the traditional credit bureau, the more you will be able to underwrite better thin file customers, in other words, customers that do not have credit bureau information, or even make better decisions for the customers that do have credit bureau information. So it's not about identifying this data source or that data source. It depends on the product, of course, and it depends on the market. But there are so many different data sources out there, and the more you could leverage, the better results that you could obtain in your business in terms of performance. So does that give you a bit of a clarity around the data that is being used?
Yeah.
Yes, no, skeptical.
Maybe to add to that, perhaps.
Side. I mean, because the main point is to prepare, deliver, and create products which is customer oriented.
Correct.
And I think that it's very important to have customer opinion about that one. And most of the institutions, what I know, actually, let me introduce myself, because I'm doing the 10 years approximately customer experience advisors and creating the touch points for different kind of the sectors, including the financial sector, including the banks and so on. So sometimes I'm having the problems to explain some kind of things because the people do not understand rightly to use the data, actually, to collect the accurate, correct sources and to use them the right way. That's why I was asking you as expertise that what do you think about that?
Okay, I can answer that.
Yeah, maybe because there's also data privacy is obviously a hot topic in that sense. But what I see happening is that we go into what we call sort of instant credit scoring. So you will ask customers you ask them, do you want to share certain data, for instance, transaction data with PSD2 open banking that will become possible. Do you want to share your mobile phone data? Are we allowed, or do you want to share LinkedIn data? So it should be the customer who is in charge, in control, and depending on the information that he is prepared to share, you will have different process. So if they want to share a lot of information, then probably he can get a loan in 5 minutes maybe. But if he's more reluctant, then maybe he needs to answer more questions. He needs to provide more documentation to allow him to approve him for a credit. So it's really where the customer should be in control, should know what happens with the data, should also get feedback if their decision is not positive. So the transparency part is very important as well. And I think with the current techniques and many players in the market who are already saying that they are doing all kind of predictability models on transaction data, some is true, some is sort of in progress. There's lots of opportunities to really implement that type of service. So, but it's important that the customer trusts and understands what's happening with his data and is in control. That's a very important topic.
So maybe, if you allow me one minute addition to this, there are certainly there are traditional sources of data, which is the financial statements of the companies or income of the individuals. But this kind of information is not trustable, especially if you go to emerging markets. Each SME will have at least 3 accounting statements, one for tax authorities, one for bank, and another one for, which is true. And the true one, nobody sees this except for the CEO. So this financial data needs to, banks don't really use it, so you have to use proxies for this, so transactional data comes in very handy. It's usually a combination of different data sources. It's actual data, accounting data of the customer, of the enterprises, behavioral data of the companies, and demographic data. So just giving you an example of the alternative sources of data that we use in our work, we're developing a credit scoring model for one of the banks in India, and the data is scarce. It's very difficult to get an access to the true data. The credit bureau, as Konstantinos mentioned earlier, is not really functioning well. You cannot trust this data. You cannot trust the data provided by the enterprise. But you have to develop the scorecard, the scoring model. So what we did, we actually went on the market and collected the data that will be proxy to the financial income. For example, what is the size of your TV screen in your household? How big the screen of your television? Do you have the refrigerator in the house? How many dependents do you have living in the house? How many square meters is your house? How many neighbors do you interact on a daily basis? So this kind of data, which we, as bankers, we don't really think that will make sense, but actually there is used in a smart way. But of course, you need to develop certain testing mechanism, and you have to test the data and the results of the models.
I think one of the key points that is being made throughout the discussion is it's not data for data purposes, it's responsible data. And it's fascinating just to hear those alternative sources of data that traditional banks wouldn't consider in being able to put credit scoring together. Unfortunately, we have run out of time. I did want to touch on blockchain and artificial intelligence, but I'm sure that will come up through further discussion. I'd like to thank you as the audience, and especially that you're still here, even though the time is up, because that's an indication of how well our speakers have spoken. And I'd like to thank our speakers because, one, they're extremely knowledgeable and extremely experienced people who are able to bring a greater understanding to financial inclusion. I've learned a lot today by listening to them, so if you could put your hands together, please, and thank them for us. Thank you.
Thank you, Frank.